Welcome back. My name is Chris Sashnelli, and I get to build, buy, and sell simple, profitable businesses every single day. And today we are going to be talking about how to value a simple business, right? So, first off, Bootstrapper Capital, we are in the business of buying businesses, right? We like to call ourselves a baby Berkshire. We are slowly building a portfolio of beautiful, boring businesses, and we're all about getting to simple, profitable outcomes. We also help other folks do the same. So what we do for ourselves, we do for others through our advisory agency business, simpleprofits.io. And many times, a lot of the conversations that we have, and oftentimes a lot of the questions that come up is simple. It's how do you value a business, right? So if you're buying a business or you're into the game of building wedge equity inside of a business, which is simply, making a business more valuable, like what it's worth today versus what it's going to be worth tomorrow. And the thing in the middle is the wedge, right? Which is what we focus on. How do you build wedge equity? A lot of that comes down to, what's the baseline? Where did you start? How did you get to an initial valuation? So for those reasons and probably more, today's video, I'm going to try to keep it as simple as possible. This can be extremely complicated. This can be extremely complex. And the more sophisticated the deal, of course, it should be. However, again, we focus on simple, profitable businesses, simple deals. So we're going to try to keep this simple. The first things first is price, right? And a lot of folks are just like, all right, it's a private company, right? It's a small business. It's a micro SaaS, whatever the case may be. Like, how do you come to a value? Like, what is a price? And at the end of the day, like, we just got to always remind ourselves, right? Price is just what someone else is willing to pay, right? Now, there's a market, and markets kind of indicate what a price should be. But at the end of the day, say you have a $1 a pencil that's worth $1, and then all of a sudden some billionaire somewhere is willing to come in and say, hey, I think that pencil, because it was on that desk at that time, used by that person, is worth $100 million, right? So now all of a sudden that pencil that's, otherwise everybody else in the world is like, that's $1, that's $1. Now all of a sudden it's valued at 100 million because somebody was willing to pay it, right? So first things first, let's keep it simple. At the end of the day, price is just what somebody's willing to pay. Now, that being said, oftentimes, the market does dictate price. It dictates price because usually what people are willing to pay is influenced by the market, right? So traditional market norms, meaning like if somebody else is buying a pencil for $1, if other people are selling pencils for $1, like it's kind of unjustified, an obscure concept for me to go and buy a pencil for $100 million, right? Like the market kind of dictates supply and demand of $1, right? So typically the market influences price, right? The market norms, meaning, when we look at businesses, that's why when we do look at businesses, there's ways to kind of value a business, and the ways in which we value a business, right? So we are a business that buys businesses. The way that we'll value a business is oftentimes very similar and standardized to a certain extent to the same way other people buy businesses, right? So it's like we're all assessing the same thing. We're kind of working within this normalized society, right? And because we're all kind of thinking similar ways, like now maybe some of us have, insights or intel or some level of a competitive advantage that shifts our perspective. If you change your perspective, you change your approach, right? So this is not in the world of absolutes, right? But oftentimes we're looking at things fairly standardized, fairly similar, because again, those market norms kind of push and shape us to do so, that way. Unless there's some, irrational or unknown reason why, right? And you always got to follow the why. So typical ways in which somebody would value a business is, these, right? So it's typically either a money multiple. So a money multiple being like a multiple on your revenue, top line revenue. Some folks will just look at top line revenue. Some folks look at EBITDA. Some folks take out things and they look at like seller's discretionary earnings, meaning like what is the amount of money that the seller or the owner of that business is actually putting in their pocket after things are all said and done, right? What needs to be added back in to be able to normalize that, etc. So, And most typically, this is the way that it's done in our space. We do it this way. I'll talk through how we tend to do it, because we tend to start really simple, as basic and simple as possible. And then as the need arises, you'll start to add in additional complexities to make sure that you are diligencing the deal appropriately and you're pricing it appropriately. And ultimately, everybody is getting a fair value and a fair deal when the deal gets done. But you'll have these money multiples. That's one way, that's the most common way. Another way is asset multiples, meaning like you'll look at the book value of an asset, of the assets inside of the company. Like if you were to just take the core assets and then liquidate them, what is that worth, right? And what type of multiple? Either a positive multiple, or also always remember you can have a risk ratio too. So a multiple could also be a negative thing. Multiple doesn't always mean more, right? Like you could have a 0.7 multiple and you end up with less than what it's worth today, or what book value is, right? So then you have the asset multiple, which is like inventorying all the core assets, the things that could otherwise be liquidated or traded, right? Great way of thinking about that is like real estate, similar to like an asset side of real estate, would almost be like the build value. If you were instead to buy a house, what would it cost to build a house? That's like another type of concept in terms of how you could frame it out or look at it from that perspective. Like what's the realized cost basis of this type of stuff? Also, very many times, more often than not, it's, what's the value when it's traded on market, if you were to sell these assets off. So, back in the 80s, when it was like corporate raider time, somebody would come in and say, hey, maybe this company today is worth more as, the liquidation of its parts. And you would have people come in and buy whole businesses, and then they would sell off all the equipment, or they'd, spin out a division or whatever the case may be, sell it to the market, and they realized that they could arbitrage that way, right? So you got money multiples, you got asset multiples, and then you got market comps, right? Market comps is just like looking at other similar type of businesses and seeing what they've traded for in the past, right? Within a realm of time, right? Because time does dictate deals, right? Markets shift, markets change, market pressures change, different types of competitive moats go away, macro changes as well as micro changes, right? So when you're doing a market comp, you got to be fairly narrow in terms of your comps. But you could just look at other similar like businesses and be like, all right, well, what did this sell for, right? And you're going to make a market comparison. Oftentimes that market comparison is also going to correlate heavily to the first two as well in some way, shape, or form, right? Because you need to be able to benchmark appropriately. Market comps, I mean, that's very similar to what you see when you see real estate trading, right? So when you see go on MLS, for example, most of those houses are priced according to market comps, right? So that would probably be a great example there. If you're doing more of like a investment property or commercial property, probably similar to that of the first two, right? When we buy businesses, these are the ways in which we look, right? You're looking to either add a multiple to the monies, right? Whether it's revenue or EBITDA or seller discretionary earnings or some other monetary numerical representation and benchmark, or you're looking at the assets, or you're looking at market comps. Now, these are the three most common. It's not to say that there's not other ways in which you can. There's definitely other ways in which you can. In fact, you can do anything, because at the end of the day, a price is just what someone is willing to pay. So at the end of the day, you could value something however you want to value something if you have the checkbook to do so and you're the one writing the check. But again, traditionally speaking, again, the market does influence, social norms of how things are done, because that's how markets are made. And then that also dictates price. And these are the ways in which that typically takes place. So for us, right, with Bootstrapper Capital, when we build, buy, and sell specifically on the buy side, specifically when we're looking at like a simple SaaS or a micro SaaS or some sort of small deal, right, we'll typically look at the revenue, because that's just the easiest way, like the simplest possible way, really the simplest way, because you're just looking at one thing, inclusive in that one thing, you're going to diligence it, and you're going to look at other things like, customer retention numbers, churn numbers, how long has that revenue been, what's the lifetime value of the revenue. So you're going to look at different components of the revenue. but you're just really looking at that one number, and then you're adding a multiple and then a risk ratio to it, and that gets you to a simple valuation. And that's a really simple way to value a deal. And especially for us, like if you're ever on a call with us or you ever, float a deal across us and we're talking about it, like we can sometimes just value something on the spot to a certain extent, right? Within the realm of variances, right? Asterisk, asterisk, asterisk. But that's why there's always a why behind it, because things change trade at certain multiples. Also, you got to keep in mind that when you're doing deals, different types of deals trade in different types of ways, meaning like there's an intrinsic value that's different for every single different type of deal. Like, for example, an agency business, right? If you're out there selling an agency business, you may try to get that or see that trade at like a one-time revenue multiple, or maybe even a discount into the revenue, because there's different types of intrinsic risk associated with that. We'll get into the risk and the risk ratio, and then how you can optimize around mitigating risk to be able to maximize the value that you're going to see by building wedge equity in your business in a little bit. But I just want you to be aware of that, right? So like different businesses trade at different multiples, right? You're going to categorize and subcategorize your business because they're different business models. There's different market risks associated. A SaaS is going to trade different than an agency. So I just want to make that point well known and clear, right? And again, this is a simple video on simple valuation, so we're not going to get too much into the weeds, but these are things that we do talk about all the time in detail, devil's in the detail, especially when we get onto diligence calls inside of the community, or we're looking at reviews of deals, or we're doing deal diligence in public, right, which we'll oftentimes do inside of the bootstrapper community. If you're interested in that, definitely join. So let's say, look at this example, simple math, right? So say we have a simple SaaS, right? It's doing $1,000 a month in revenue, right? A simple valuation, a really simple on the fly, on the spot type of valuation, to just like set a marker number and then to diligence from there. We'd say something like $1,000 times 12 months will give you a run rate of $12,000 a year in revenue, right? So we're forecasting out that you're going to get 12,000 in revenue, and then you're going to add a multiple. And in something like a micro SaaS, which micro SaaSes have a little bit, have more risk because they're smaller deals. There's more risk associated it, change in customer base, change in market competitors. They affect micro SaaSes differently than more of a traditional growth stage SaaS, whatever the case is. So the multiples, are lower to a certain extent. And then on a per deal basis, you're going to add a risk ratio, which I'll get to in a second. But in our space, micro SaaS, you're seeing like maybe like a 3 to 5 time multiple. That's like kind of where the market's at. It's starting to trend a little bit more down with, the fact that there's not as much credit available to do deals, right? So there's not as much, many buyers, not as much appetite on the buy side. So thus that impacts prices as well, right? Supply and demand. More people want to buy something than there is to sell, prices go up. There's more sellers, right, than there are buyers, prices are going to come down. The market gets made at the equilibrium, right? The point in which, again, those market social norms come to play. That's why typically that's what dictates price, or an indication of price. So in this situation, we'll use a simple 4 times. We'll split the baby between 3 to 5, 4, right? So you just take 12K, multiply by 4. That gets you to roughly 50 grand. It's 48,000. So we'll say like this is a 50 grand deal. So I'd put in an offer at 50 grand for this. I'd say, all right, probably around $50,000. However, there's this other thing that you have to take into consideration. And sometimes people forget about this, or if it's your first time doing a deal, you don't know. Right. And so, you just don't know what you don't know. You know what I mean? So that's why we're doing this video. So you can be aware, right? So you can learn from our experiences. This is what we do. This is how we do it. This is what we look at. I'm still learning and growing myself. There's so many things from folks that do way more sophisticated deals than I do, than we do, that I'm always constantly learning too. But keep it simple. I'll look at the business and then I'll say, what's the risk ratio onto that business? So that kind of gets back to the talk track from earlier of like, an agency business, there's a lot of risk. Like maybe you're going to, lose maybe the customer base, the clientele base is very owner loyal. And when they sell, right, and the book carries over, people leave. So that you're not going to get that book. So there's a risk ratio to that, right? Or like maybe it's brand, right? Maybe it's other competitive moats, right? Time in market. There's like so many different, we'll go through actually in the next couple of slides, like all these different ways in which you could think about risk ratios. But the fact of the matter is there's always hair on the deal. You got to be aware of what the risk is. Your job as a buyer is always mitigation of risk, right? Your job as a seller is also proactive mitigation of risk, because proactive mitigation of risk is what builds wedge, and that's what gets you the best possible terms at the best possible valuation, right? So like it's both parties' responsibilities to do good deals, right? So you got to be aware of this. The risk ratio typically is a negative thing. So typically you're discounting into the deal. So if there's a risk ratio here, I'd apply that risk ratio to the 50K, and then my offer, like what I would actually get into a letter of intention and an LOI around and make an offer with, would be lower. So like it may be $30,000, and there would be specific reasons why, and then you're going to continue your diligence to be able to figure things out, and then eventually the market gets made, etc. Right? Now, when you're doing deals, it's important to know that you can manufacture deals both on the sell side and on the buy side, right? And the way in which you can manufacture deals is to be able to look at this thing called the wedge, right? So wedge equity, right? Which is to simply build a better business, right? So you want to look at the parts of the business. And if you're buying a company, your job is to then ultimately integrate it. So you're going to acquire it, and then you're going to integrate it, and then you're going to stabilize it, right? Make sure that it's stable, and then you're going to optimize it, right? And you want to get a good return on your investment. You want to follow, maybe put together a good 100-day plan because you went at it with a strategy. You knew exactly what you were doing. You did that while you were diligencing the deal, right? Because you're a good buyer, strategic buyer, etc. You want to get a good return on your investment. So you're going to do these things that mitigate risk. On the sell side, you can also do these things proactively. And by doing them proactively, you're mitigating risk for the buyer or the future potential buyer, which takes leverage off of the table on them to be able to negotiate or beat you up on the price, right? So if you take away the reasons why somebody can add a risk ratio, then they can't add a risk ratio, and thus you get a better deal, right? So that's what that really means. So ways to do that, if you were interested in doing that, say you're selling a business today, ways in which you can do that is to implement a operating system and build operational equity, right? So that's like organizing your business, strategizing around the information which you organize to then standardize to then be able to optimize so that you have a more investable of an asset, right? And you can also do so by optimizing your brand equity, which is realistically market positioning, right? Maximizing the value in the market, right? These things are easy, they're simple to say, but they're definitely not simple to do, right? On the buy side, you're kind of diligencing the same way, right? So when you're looking at a deal and you're getting to a valuation, right? These are the things that you're asking yourself. So I'm trying to take like a buy side perspective, right? I'm trying to definitely share from a buy side how to value a business and pull back curtain there. But at the same time, by pulling back curtain, I'm also sharing on the sell side things that buyers are looking at and how they're diligencing and what they're thinking and how they're getting to a valuation or a price. So you can proactively kind of maneuver against that, right? So like on the operational equity side, it's like, how simple is the business, right? Is it a simple business? Because a simple business is way more valuable to me than a complicated business. I like simple things, right? Like simple things tend to break less, right? There's less complexity in terms of like how you're collecting your capital or like how you're getting money back, money movement through the machine, right? Like if there's continuity to the business, is it clear what the business is or where it's going? Does the team know that, right? Alignment of the team, how documented, how well documented are the SOPs, like standard operating procedures, or the processes, or like who's doing what, how inside the business to keep the business running? Like, is this business a job? Right? Are you selling me a job that I have to now do more work? Or are you selling me an asset, right? Something that somebody else can do the work for and I get paid by owning it, right? I pay way more for an asset than I do for a job because the job's a liability. You'll probably have to pay me. There's going to be a risk ratio onto that, right? So you want to do all of these things and make sure you have an asset at the end of the day. Investors buy assets, they don't buy liabilities, right? By having this stuff, you're going to have more consistency of the outputs, right? So less fires, right? Less problems for me to have to deal with as an owner, right? Especially if I'm a passive owner, which also means like more consistency in the product or the outcomes, which means potentially a higher customer satisfaction, right? Higher customer satisfaction, also easier to market into something that's consistent, so lower customer acquisition costs. Like there's just so many whys around why these things are so important and how they impact value. And if you're not looking at these things on the buy side, you're probably going to get hosed. And if you're not proactive into these things on the sell side, you're probably going to get beat up on price, right? And then all of it at the end of the day, it's like all about, typically profitability, because yeah, there's three different ways in which you could value a business. I mean, there are different types of deals that get done. So not always everybody's buying something for an income like profitability. So sometimes people are buying it for the assets to strip it down, like we were talking about earlier, different reasons. So you got to follow why. You got to always know the why. That's why also we promote heavily, lead with the why, know the why, right? Lead with the why into the deal, know the why of both sides of the table so you could get to a win-win deal. For us, it's all about profitability, right? We buy simple, profitable businesses. So that matters, right? So if you're on the sell side, you got to ask yourself, like, how easy would it be for somebody else to take this over? Right? If you're saying not easy, then you're probably going to get beat up on price. There's probably going to be a high risk ratio that's added to discount the price of your value of your business, right? If you're like, no, somebody could turn this over tomorrow. I could walk away. Somebody walks in. There's really no lapse in productivity or profitability of the business. That's awesome, right? You're going to get a premium for that, right? You may get a negative risk ratio. You may get a price premium, right, for something like that. Right. And then at the end of the day, it's like, am I buying myself a job or am I buying myself an asset? Right. Am I buying a liability where I have to do work? Right. I have to show up. I have to think. I have to be present. Right. Or am I buying myself something that will run itself because it's got a lot of operational equity in it. It operates really nicely and thus it runs for a profit and I get a return as an investor. Right. You got to ask yourself these questions because these are the things that buyers are asking to beat it up. If you're a buy side, you got to ask these things. Otherwise, you're going to get, hosed in the deal, right? And that's where you get buyer's remorse on the backside. So get proactive into it. Then you got this other thing called brand equity, right? The other thing is the brand equity. Like brand equity drives valuations, right? The better the brand, the higher the value. The worse the brand, the lower the value, right? Why? Because it gives you competitive market advantages. A great brand and market gives you a competitive moat. It gives you potentially like price, a competitive advantage on price, which means you could charge more, which means you could have better margins. If you have better margins, you could pay people better, right? Have better operations. You could potentially pay more to acquire customers, right? Whoever could pay the most to acquire the customer typically wins the deal, right? So for all of these reasons and definitely more, it impacts the value of your business. So you got to care about it. You got to care about it on both the buy side, what you're buying when you're diligencing the deal, and also on the sell side when you're selling. So you got to think about these things like how much does it cost to acquire a customer? Are the customers that we already have? What is the average lifetime value of these customers by cohort? Meaning based off of when they joined our book of customers, right? Our customer base. When you bring them together by cohort timeline, right, or some other milestone campaign, something like that, what's the value? What's the lifetime value of these cohorts? And then what's the average value of all the cohorts, right? Is that lifetime value greater than the customer acquisition cost? Because if no, then that's not a business that's making profit, right? That's losing money, discount, risk ratio, reduction of price, right? So you want to know these things. Also, if you don't know these numbers, people are going to assume the worst on the buy side and you'll get beat up. So again, on the sell side, you got to get proactive into this stuff. On the buy side, you gotta be equally as proactive and you got to be aware of what you're buying and you got to ask the right types of questions, look at the right things, diligence it appropriately, and mitigate the risk, right? You got to look at the future value, right? What's the future value of cash flow going to be? How long will this business be a business? How long will it be paying you, right? How much future cash flow will you collect off of this asset, right? Oftentimes that's at the end of the day what you're really asking yourself when you're pricing it out. It's like how much am I going to make from this business? Like how long do I plan on owning this business over the period of time in which I believe I can own this business? Like maybe it's going to go out of business. Again, risk ratio, discount price, right? But if this is a perpetual business, how long will I own it for? How much profit will I extract from it over that 10-year of term, right, in which I own it? And then, when you take that into consideration with what I pay, what type of rate of return do I want to receive, right? What type of return on investment do I want? Either an internal rate of return or a return on cash, whatever you're thinking about of how you want to benchmark your performance. Realistically, you just got to back in from that, and typically you can get to a price that makes sense for you, right? If you diligence it well, right? You got to really diligence well. That's why for us, pull back curtain, super transparent, right? Like build in public, what we're doing with Bootstrapper Capital. That's why with Bootstrapper Capital, we lead heavily with implementation of an operating system. Like if we're doing a deal with somebody, we want you to implement an operating system because it's an easy way for us to diligence a company, figure all this stuff out, see the deal. We oftentimes position it with our safer so that we could also get a sense of a benchmark in terms of like true financial performance, right? Because if you're already a portfolio company within a safer or within any sort of confine of that, then like we have better intelligence, right? We have better intel on the deal when we're diligencing it. We can align into building wedge equity. So even if things aren't great today, that's perfectly okay. We understand that life's a real thing. We can help you. We can partner with you. We can partner into the deal to build the wedge, get you to a favorable price. And then instead of dealing with somebody else in the market who's just going to, maybe be ignorant to this stuff because they haven't done it before, or they're going to, they have done it before. So they're going to beat you up on price. They're going to beat the heck out of you. We don't do that. We partner into the upside. So for all of those reasons and definitely more, that's also a big part of our approach. Like I genuinely believe we are the most bootstrapper friendly, the most founder friendly, the most entrepreneur friendly firm out there, period, doing deals because we are you. Like we get it, right? We feel the pain. We felt the pain. I get it. I'd much rather partner onto the upside with somebody and make sure that everybody wins. And then hopefully we go and do it again, right? As opposed to try to get a fight to the bottom. That's stupid. It doesn't make sense. So with this, you got to ask yourself, like, how much time is it going to, take me to recoup, my customer acquisition costs? Like how much until I'm in the money, right? Like if I'm paying, $1,000 to acquire a customer and I'm only receiving like $50 a month in revenue or $10 a month in revenue, like it takes a significant amount of time to recoup that customer acquisition cost, meaning like for me to collect the revenue that then matches what I paid to acquire that customer. And if somebody's going to churn, meaning like they're no longer a customer before I recoup it, then I lose money, right? Again, risk ratio, all of these things, right? You gotta think about this stuff. These are just simple frameworks. If you want help buying a business, we have a business brokerage, right? A part of our firm, help you navigate those waters. If you want help selling a business, right, we have an advisory firm where we'll take you through and help you build wedge equity. We get you to like ideal. We try to increase and grow your market valuations by building the wedge equity, get you the best terms, right? We'll take you through a structured advisory program to be able to do that. That's through Simple Profits. We also have the brokerage side, and we also buy businesses ourselves. So it's a really nice ecosystem that we have that we're building to be able to help folks through all of this stuff, right? So if you want to build wedge equity, right, if you want to get the best possible deal, if you want to get the highest possible valuation for your business, then at the end of the day, you got to focus on, reducing the risk ratio, which oftentimes the reduction of risk ratio comes from focusing on the operational equity. So, right, getting to a really simple operational business, like focusing on those components of the operational equity, that reduces risk. And then if you want to increase the upside or the multiple effect, multiple arbitrage, that's when you're really focusing on brand equity. Not to say like they don't both impact both, right? So like you can increase multiples through operational equity and you can decrease risk through brand equity. So they are fairly interchangeable. It's just like when we focus and we simplify, a lot of the times on operational equity, it's like talking about let's reduce risk, let's mitigate risk through better operational efficiencies. And then when you were talking about like let's grow multiples, it's usually on the brand side, the revenue side, right? Market expansion, right? So I just want to asterisk that, but I also want to give the why in terms of why I'm saying like, operational equity is better aligned with risk ratios and brand equity is better aligned with revenue multiples. That being said, that's how you value a business in a simple way. Simple works, but simple is definitely not easy. This is definitely not the only way. There's many, as we discussed today. And as you go through deals and as you work through it, even though you can start simple, highly, highly recommend, even though you want to keep it simple, you don't remove the complexity, right? Simple doesn't mean that it can't be complex. It's just you want to keep it simple, right? So that you can execute well, right? When you get into these deals, these things are very complex. And even if it's a small deal and it's a 100K deal, that's still a significant amount of money. That's a life-changing deal for a lot of folks, right? There's risk associated with this. So you want to do a really, really, really good job, right? Even a small deal can carry forward a lot of liability if you buy wrong, right? And if you sell wrong, you could leave a lot of money on the table. I've made that mistake many times in the past in my career, right? Big part of my why, big part of our why with what we do with Bootstrapper Capital. If you enjoyed this content, let us know in the comments. We're constantly trying to figure out how to better perfect the content which we put out to this community and to the channel, right? We want to understand what you're interested in so that we could better, focus and provide you with that. Please like and subscribe if you watched it this far. Thank you so much. And until next time, I'll talk to you soon.